This is Dawn Rickabaugh with Property and Paper Live with NoteQueen.com, and I'm here to host a conversation about real estate and notes, property and paper. And it's kind of funny. People don't know what I mean by property and paper, and it sounds so funny. And I remember in the early days, I didn't know what paper meant. It just seemed like, what? What are we talking about paper? But in this case, it's a note, a receivable. And so real estate and notes to me are just two sides of the same coin. And once you the big thing that we have a lack of education, even in really sophisticated real estate investors and a lot of the professionals that serve them, their realtors, their title companies, their attorneys, they just really don't know anything about the secondary market for notes. And that's the big piece that's missing here. So that's one of my funnest things, is to try to fill that gap. And so I'm here hosting this Property and Paper live call twice a month. So if you're just listening after the fact on the podcast or YouTube, thank you very much. I appreciate it. And if you want to join live so that you can ask your own questions, this is twice a month. This is where I show up to host this amazing thing, and for free. So as much as we can pack in to 45 minutes to an hour, we're going to do it. So if you just want to hang around and before you make a lot of investment, this is the place to go. And you can always register for the next upcoming call by going to propertyandpaper.com. That'll always have the next Zoom registration. So that's how to join us next time live if you would like. And just a reminder, if you would like me on, these are the 2 times that per month that I show up for free, and I love it. And there's so much value here, and all of you give richly. There's so many people that give richly on this call that I've learned a lot from all of you. So, but if you want me on your timeline and to discuss a private matter, I do have paid consulting options, 15-minute and 1-hour deep dives, if that should interest you. And just to remind you, if you don't know already, I wrote a little book that I think is a fantastic way to get your head, especially if you're new and you want to have a 15 to 30-minute read, go and look at, what did I put it under? Boomer Real Estate Rescue. And I think I made a domain to go with it. So if you can go to my website at notequeen.com/shop and you'll see it there. But you can go to Boomer. Yes, because we're old, and I was the last year of the boomers in 1964, boomerrealestaterescue.com, and it'll take you right there. It's a really fabulous place for people to start. And also there's some nice bonuses for you if you go to get additional things at prices that you won't see elsewhere. So that's that. So fantastic. Look at you. Sarah, thank you. I appreciate it. She's got the link in the chat. You are a doll. All right. So where do we want to start? I'm going to be quiet for a second, and I just want to see who wants to unmute. Brenda, hello.
Hello.
It's
Hello.
so great to see you. It seems like forever.
I know.
Yeah, so fantastic. So where are we starting? Where are we starting? Nobody? I know Piper and Denise.
I could ask a quick question or two if
Hey, is that oh, are you Denise? Okay, sorry. I'm looking all over. Okay, and then if I go to the view to speaker, then I can see you. Okay.
And I was looking for the raise hand thing, and I finally found it after I spoke up. But
oh, right. I know. It's under the emoji thing or something, right?
Yeah, it's down there in the bottom, and I just didn't scroll far enough over to see it. But
yeah, so just tell me, like you told me a little bit about yourself in the email. Let's introduce you. And so
sure.
What's so great about you guys being willing to do this is that there's so many people that will not raise their hands and will never speak, but they need you to ask the question so they can get it answered. So I greatly appreciate everybody coming on here. It's just would not be the same without all of you. So
Well, I am, as I said in the email to you, I have done some residential real estate investment. And in my style, I mean, I did my homework, did my research, found the kind of guru that I sort of wanted to follow, and made sure I was really confident and comfortable with the approach. And actually, reviewed the first deal with him, made sure I really was, setting myself up properly. So that's kind of the approach I tend to take. So I had been attending a couple of his meetings and stuff for 2 or 3 years before I finally pulled the trigger.
Right.
I now own 10 residential real estate properties, 9 single family and 1 duplex.
Mhm.
They all cash flow. They're all out of state. They're, other side of the country, with property management in place. They're doing great, but the market's shifted, and I'm not looking to. The market's shifted, and my life stage has shifted. I'm now moving into hopefully pulling the trigger on retirement from the W-2 job later this year, early next year at the latest. And
Wow, that's big.
but I don't want to start tapping into Social Security or my 401k IRA savings or anything like that. I don't want to tap into that for the first 3 or 4 years, because I want that to continue to grow, right?
Right.
So for the first few years, my cash flow is a little tight. And what I'm looking to do is I've attended a couple of your events. I've taken a couple of the
Uh,
workshops or whatever. I think Tracy Z
yeah,
is
Tracy Z and Fred Rui, right?
really, yep. And
Huh?
and so, I feel like I'm at the point now where I've learned enough. It's time to get specific and take action, right?
Right.
And so where I'm focusing in is I want to do a plain vanilla, just kind of not like there's lots of really cool, crazy, creative stuff that people do. And it's fascinating to listen to that and to kind of see where people can take things. But I want to start basic, plain vanilla. I'd like to just buy an existing note that's probably first position performing note, probably let's say under 50K or under 75K as the first one, with at least 3 to 5 years of payments remaining, that kind of thing. So right in that sort of sweet spot, just to kind of pull the trigger, do the deal, see it work, right?
Yeah,
And,
yes.
and once I do one, I'll do another, right? And eventually, the properties that I do own, although I have property management, it doesn't keep me free from things like, oh, surprise, you have to replace the septic tank, or oh my gosh, it's time to replace the roof, right? So, eventually I would probably sell or finance those as a means of getting out, but that's a ways down the road, right? Right now, what I'm looking to do is augment that and my other investments by, picking up a couple of notes and just adding to my cash flow that way.
Fantastic. Thank you for the share. And I think a lot of people might as I suspected, relate to your story. So if I were to reflect this back to you, you've got these 10 rental properties, you like the cash flow, you're getting ready to be W-2-less. And you realize that since you don't want to tap into other retirement funds, pensions, that it's going to be a little tight. So you don't want to pick up any more property because he's seeing the writing on the wall, and things are, like you mentioned, are shifting. And yeah, that's a nice soft way to put it.
Well, every single one of the deals I did before, when I purchased the residential, my criteria was it had to cash flow at least $200 or $300 out of the gate on a monthly basis.
Right. All right. And then
Like that right now is not happening.
No, it's really tough. And I guess in certain parts of the country, and if Kathy's on here, like, in the South, in some areas, they do still cash flow, but then, it just depends on where you want all your stuff. But anyway, you're thinking, instead of picking now these properties, they cash flow for you. And now you want to take some money, and you don't have to, like, buying a property is a lot more, if you buy it all cash, of course, can be very cash intensive. And then you have the repairs that can come out of nowhere. You think you're cash flowing nice, and then all of a sudden you got a $20,000 bill, right? And so you're just thinking, and by the way, that's the reason when you calculate, does a rental really cash flow? You have to calculate a 35% minimum reserves, gross rents minus 35%. And if it cashes at 65% of gross rents, then you really have cash flow, because it's just a waiting game at, those costs, those big costs have to be baked into it, unless you like taking surprise, money out of your savings account for a surprise thing. So, but anyway, so you're just thinking, hey, let me do notes because I want cash flow that's easier and it's not cash intensive, and you're not going to get the surprises unless you have a default scenario, which, is you want to avoid.
Yeah, I'd rather avoid. I mean, at the end, down the road a bit, if I have one that's a little iffier and it ends up in a foreclosure, or I end up taking ownership of the property, if I've done the homework properly, I know how to manage a residential property. And
absolutely. Okay, a quick question. And so I mostly got everything. Did I miss any key points?
I don't think so.
Okay, great. So do you have bank financing on all of your rentals?
I do have financing on all of them.
Okay, well, what sort of equity position do you have in general? And don't answer if it's too personal.
No. It's actually it's about 46% loan to value at this point across the portfolio.
Oh, so you have a fair amount of equity. Yeah. And so that's phenomenal. And so one thing, okay, I know what I want to say, but what is it that you asked me again that you want me to go for? Okay, the easiest way to get going in notes, right?
Yeah, I'm looking like paper stack or something like that. And
okay.
Just, how do I evaluate? How do I?
Yes, and I love this because this is fairly common. And you know what? I'm going to just make a little mini course around this because it's just so important and so common. And this is great things that a lot of people are scratching their heads. In fact, I was just I got invited to a sort of inner circle club to present, to some people who have more money than time. They're doctors and dentists and, professionals that make a lot of money, but don't have a lot of time to deploy. So it was really fun connecting with them, but they have the similar questions. They're not sure, how do I do it? So it's interesting that everybody from beginner, you have no money hardly to do anything with, to you have hundreds of thousands of dollars, or millions waiting to deploy. You could still be scratching your head trying to get your head around this. So I always say, which I said earlier this week to those people, is the easiest way to get started in the note business is to carry paper on property you already own. And you said you don't want to do it now, but later. But I just want to, and if anyone else has comments, feel free to jump in. My perspective, though, is that you started out saying things are changing, and that's why I don't want to acquire more property.
Yep.
So if it were me, this is a time to take profits. This is a time to at least take and position to hunker down a little more, because right now you've got 54% equity position. If the market softens, that could go down to a 20% equity position. Now, just in general, and I don't know your personal situation, where you're invested, what type of property, but just as a general rule, you making a point of like, I'm getting into a time where I might need more passive income. I might consider taking a couple of my properties, paying them off and getting so sell two and then pay the loans down on the two others so that you have two free and clear properties, so that you're capturing the profits now, because we're at a high, and some people say go higher, but I think we're both seeing that we want to be careful and just position to be a little stronger. So more cash in the bank, take those profits while things.
I've looked at that as in terms of a straight sale of like one property pay off another, which keeps
Mhm,
the same cash flow, one less property to worry about, right? One
mhm.
less property where insurance is going to ratchet up yet again next year.
Exactly.
Um, so that is an option, or 1031ing into a different property, but I'm not sure I want to do that right now. But
Yeah.
so if I were to go the route, so there are two properties that I own that I would consider, for something like that. So the first two that I bought were sort of rehabs coming out of the 2008 crash. So they're a little bit older properties. They're like mid-century last year. They were fully rehabbed in 2012, 2013. The rest of them, all the rest that I bought are all brand new. Were brand new construction when I purchased. So the two older properties, which bring in less, and I also have lower balances on them, are the two that I might be open to doing something with.
Right.
So
Well, it
go
just,
back on how do I go about it?
yeah. Well, oh, just selling them?
Yeah.
Well, anyway, I don't want to get too far down in the weeds here. And Sue Ellen is mentioning it's risky not to carry debt, and I agree and disagree, because to me it's all about a balance. Now, what you have to look at your own personal net worth, and yes, debt is great, because why, like the government, it's continually inflating so that it's paying, with cheaper dollars over time. uh but if it's kind of like, to me, you just have to balance it. Yeah, I like as much debt as possible on a lot of things, but like, for instance, I like being positioned for the worst case scenario, and I don't like debt on my primary residence and maybe one other property that just feeds me, and I don't want to just, I'm already always positioned for worst case scenario, right? So yes, debt is usually great, but that middle debt, like a lot of debt or a super little amount of debt on a rental, to me are the sweet spots. But that middle, where you're 50%, any softening of the market, where prices are coming down and then expenses are going up, and Lord have mercy if we have the government shutting down our ability to foreclose or collect rent again, and pretty soon you've lost equity, so you can't sell now and get out. If you sell, you're going to get a lot less. And if you don't sell, prices go up. If rents go down and other things go up, then you're just being squeezed out of. Now, if you have a large net worth and it just doesn't matter to you, that's one thing. But if you're feeling a little nervous about, coming up on retirement, this is where I would start going, oh, maybe there's a way to just position. Like, I do a lot of prepper things that I hope the scenarios never happen, but I'm just sort of ready. I like knowing that if this, then that, and if prices go up forever and never come down, okay, great, I'm positioned for that. If they crash hard, I'm positioned for that. If they soften, you know what I'm saying? So just, to me, that's where I love getting into the deep dives with people on a one-on-one basis, because I can really feel out where someone's at, and we can get, deep on these things and just plan. But I'm getting way away from the initial question. So getting involved with notes. So to me, the easiest place, and because the collateral, because you owned the property for a long time, you don't have to you already have due diligence in your brain, right? Because the property, and if you had to take it back, you're all right with that, right? The next best way to get involved in the note business. So if you're selling a property on seller financing that you already have owned, so that's an origination. But of course, you're lending, and this is a beginner class. So if I'm using terms that you don't understand, please help me, tell me, or if it's too boring, forgive me. But it's you're not taking money and lending it to the seller from your bank account to them so they can pay you. You're lending your equity, but it's an origination. But you still end up with a note and deed of trust, right? Now, the next easiest way for people like I'm talking low hanging fruit for people to get in, is just being a private lender. Okay. And people that want to borrow money, business purpose, just call it rehabber people, right? So um, you make an origination with money you take out of your bank to lend to them. Okay. But those are plentiful, and you've got a broker putting those together usually for you. So there's the compliance, and you need to really vet those people and still do your own diligence. But yeah, that's an origination, but you're still ending up with a note and deed of trust. So we don't call it the note business sometimes, but it's the same kind of thing. Just you're going in by origination. Now, the note business, as we talk about classically, is buying other people's seller carry paper. So you could carry paper, or you could buy other people's seller carry paper, but you still end up with a note and a deed of trust by assignment, though, instead of so all of those things are ways to participate in money or equity being secured, by a property. I mean, a loan, right? Cash flow coming in, being secured by a property. Does that make sense? Are you still there, Denise?
Sorry, I went on mute. Yes.
Oh, okay, good. So you guys are chatting. I like wraps. You control the underlying. Okay. Anyway, Sue Ellen and all these people. See, there's a lot of smart people. You guys keep doing your thing while I'm going here. So does anything not make sense to anyone of the terms I've used or the concepts so far? And if so, yeah.
So,
Okay.
so one of the things that I believe that Denise needs to pay attention to is depending on the interest rates on the property she's holding.
Right.
And so if you got one with a high interest rate, that might be the one to sell, as opposed to something that's like a 3% interest.
Right.
I mean, those are like gold now, at least.
The highest interest I have on any of my investment properties is 5.25%.
So phenomenal.
Yeah.
So I have a question on the origination, because we are considering selling a property and holding the paper.
Yeah.
What kind of an interest rate can you get if you've got a qualified buyer who maybe would rather go get an institutional loan, but you'd like to carry the paper?
Then so then you have to be competitive. There has to be a great reason for you've got to do as good or better than the bank, right?
Well, they would like us because it's in a flood zone. They wouldn't have to have the flood insurance. But anyway, so we just have to kind of look what the market bears and what that particular.
Well, yeah, and it's just in generalities. There's always a million and one. You guys know this. You've been around this game for listening to people for a long time. There's a million and one ways to put a deal together and to think about it based upon what's your personal situation, what are your goals, what's your risk profile. I'm sure that you've checked with your accountant and you know what your tax consequences would be of a cash sale versus an installment sale versus whatever else you might do. Right. So those are big parts of the conversation, but in general, it's like what you agree to, what both parties agree to, and the better the terms, the better your price that you'll get. Of course, no terms are good enough if the payments don't come in, you don't have the return that you wanted. So the safety is a really big part of that, right? And then knowing if anything went weird, how do you and you or your heirs had to sell the note, how do you position that to get the most that you need to if you ever needed to shake liquidity out of it, just. So there's various things that I would put in, even if you don't plan to, let's say, is a consumer type loan or business? Is it a primary residence person?
Yes.
Yeah. So then the way that you set it up will be different, but I would say you could at least put in times where you have the right to renegotiate the terms. You know, what if prices went, you want to charge more? What if now, I don't know. There's times where you could ask for additional pay down of principal, or you could, you know, create opportunities for you to say, hey, every 5 years, we're going to look at the rate and see what's prevailing rates and what's going on. I don't know. There's just different things you could think about, but
Thanks. Yeah. Thank you.
yeah, but you know, if you have to start with for what someone can afford,
I like that
and
idea.
then
Well,
you reverse,
you
you
can
reverse.
also do a different length term too, right? You don't necessarily have to do a 30-year loan just because that's
You
what
do not. That is absolutely right. I mean, if they can afford a 20, the only thing I'm squeamish about balloons on primary residences, but if you put out a long one, you know, so I don't know, you can always put in a balloon. You're mom and pop people, right? You could put in a 5-year balloon but you don't want to be paid off, but those are points, okay, or a 10-year balloon or 15. That way you just have a point of negotiation to maximize your situation, because you don't know how it's going to be 5, 10, 15 years from now. Right. But if you don't care, and if you don't really need the money from this, you're taking profits at a great time, deferring capital gains, having some nice income. You know, the collateral, it's, you know, I mean, 5%. I mean, when I'm buying, but I'm an investor, I don't pay more than 5%. But what's the going rate, right? Is it 6 or 7% right now? 7.07? I don't know. So, and I know people that are, you know, they will, if the borrower threatens to refinance because rates went down, they go, what would it take? Okay, we'll match it. We'll match it. We just don't want to be paid off. You know, so it's more about capturing the equity, right? You're looking at, oh, I'm only making 5 or 6 or 7% on my money, but really because you're maximizing the price and, you know, you're capturing a lot of equity that you wouldn't otherwise have. It's not like you're just taking money out of your savings account, right? So you're capturing equity and probably making 10, 20, 50, sometimes $100,000 more on a property, depending, by being willing to be the bank on it. So there's those things. But so did that, what do you think about that, Dawn?
Well, first off, Diane's got to leave. So.
Bye, Diane. Nice to see you.
But too bad she's already gone.
Okay.
So anyhow, there's a lot of things to think about. It just came up right now. We've got you know, and it's been rented, and the current tenants needing to leave. So now it's just a matter of figuring it out and seeing who I want to play with.
Yeah, no, definitely. And it is very, you know, it's simple mechanically, but in terms of positioning yourself based on your own situation, what your goals are, what you're worried about, and just making sure that you're taken care of no matter what's going on. I mean, we have a lot of store closures. There's going to be a lot of layoffs. There's going to be a lot of great things happening and a lot of really difficult things. And those numbers haven't hit the market yet. Really. So I think it's good to just, anyway, I'm always thinking of, you know, just spreading, having a lot of debt in some areas and no debt in others, and taking some of it and diversifying out of real estate and notes altogether. You guys have probably heard me talk about precious metals and some blockchain, cryptocurrency types of things. That's the new financial future. So, I mean, even the bond market's being tokenized. But anyway, Kathy and Brenda have hands up. Did you have something to say in regards for Denise or for Dawn? Or just anything else? Denise, I want to come back to you for a second. You know, so you're thinking about, should I go? Okay, if you're going to be going on to, I want to get to this. Okay, this reminds me. You're like, am I going to just go on to paper stack? Of course you can do that.
I checked, oh, is it Notes Direct is the other big one, and they're offline right now.
Isn't that Eddie Speed's deal?
No, but it's got a big
So-
message that they're currently offline.
Yeah. So, yeah, I've heard some people, the pricing, you just have to, look at it. The pricing for what you get, you have to be careful because you don't know the product, right? And these are people, they might not be in your backyard. If you make a loan, if you get with a local hard money lender, you can probably go drive to the collateral if you wanted to, or, you're doing it somewhere else, but you have someone sort of looking over it. If you're buying a note, you're out there hunter gatherer and you're on your own kind of, unless you want, a lot of people have brought me on board to say, hey, help me look at this deal. And they just hire me as a consultant to say, just help me look over my shoulder on this. But here's the thing, you want to start small. So if you start, if you're looking at loan to value and you want to only spend $50,000, that means that property, a lot of them, they're probably marketing it for 60, 70, 80% ITV. So basically we're looking at a property that's worth less than 100,000. So you just have to look at that, the type of collateral, the type of person that if you took it back, there's things to look where sometimes I'd rather have. Right now, of course I'll do little deals and all sorts of things. But if I was going to say bread and butter, I want a property that's a pretty decent, solid property, $200,000 worth or more. So the only way to only spend 50 around, a small amount of money, less than 75,000 on a good property is to find it's not common, to get in, unless you're buying a front end partial. Okay. So what you're going to want to do is maybe buying a partial. I sell those out or take in partial partners, in the deals that I do. That's one of my major strategies. So that's what I would be looking at is buying partial so that you are not risking more than you want, which is, less than 75,000, but not on a property that's only worth 90,000. You want a property that's worth, like, even if the market softens up, and maybe it won't, but if it does, you still want to know that even after not getting paid for a year or two and all the legal fees and forced place insurance, and maybe you can't even get insurance anymore. Do you know that there's a lot of areas you can't even get insurance anymore? Yeah. And then there's another thought that I just thought to add into this, and then I'm going to take a breath and read all the smart comments from other people here, is if you have a note or a loan. Now, I'm not going to go there. It's too far of a tangent. I'll put that in my little mini course because I just think this is the kind of conversations that I get a lot of. And so I just want to address that. So let me be quiet and let's look at the questions. Or can you just unmute? Anyone who wants to talk, think about selling the note.
Ashley and Brenda have been waiting for a while, right?
Yeah, so, well, I told them to unmute, but I think you gals quit raising your hands if you don't mean it. It's really bothering us.
Hello.
Brenda, hi.
Hi.
Hey. So, yeah,
Can you hear
speak,
me?
woman, speak. Yeah, go ahead.
Okay. Hold on one second. Let me get where I can see you again.
Oh.
Okay, sorry. Hold on one second. Okay, Dawn. So, you can hear me, right?
Yes, ma'am.
Okay. If at some point I were to sell a property like that I live in, maybe a residence, then I would go to you for paperwork and help me with all that. But what would you suggest in finding somebody that maybe they wouldn't qualify for a bank loan that I could keep more long term?
Basically, you're trying to control not getting paid off, right?
Right.
Yeah, that's a
So
tricky
maybe someone that has great credit, however, can qualify for a bank loan.
Yeah, and a lot of times they don't want to, or like you're self-employed, right? So there's a lot of self-employed people that make a lot of money, but they have a harder time than usual getting a bank loan.
Right, because so many write-offs.
Right.
I'm one of those people.
Yeah. Yeah. So but yeah, thanks, business owners. So and I would have someone that's, has a really big down payment. I don't know if they're rolling out of another property, or they're selling something, or they've saved well, or they've got inheritance. Because now this would be a California property, right? So
Right.
so basically, California's doing some interesting things, but prices are still up. But I would just want to make sure that if your tax basis is nice and low right now. So the thing is, if you don't want to get this property back, so you want someone that can put a really big down payment, so that even if you take it back and now your tax liability is, you're probably going to resell it. But in the meantime, if you know what I mean, you'll probably be paying triple or quadruple property taxes because the basis will have gone up. So
right.
I would just make sure, but trying to force not to get paid off is a tough one, unless you just let me, if they're going to refinance and pull out money, you can't compete with that loan. So you're just going to have to prepare. And if it's a homeowner, you can't put a prepayment penalty. If it's I think you can. But any other comments, Jim?
Actually, I got a comment. So, Brenda said that that was her personal residence. So consider section 121.
Right.
Okay.
Right. So
because that's, and are you familiar? If you're not familiar with it, it's basically if you lived in it for, I believe it's 2 years out of the last 5, you can sell it tax free, or for the gain. Now you can't. You still got to deal with California if you're California, but you got to deal with the foolishness of them.
You can take off $250 if you're single, or $500 if you're married. So
yeah, do you know what your gain would be, just out of kicks and giggles?
I almost have it paid off, so it'd be a pretty big gain.
What's your basis? Like, what'd you buy it for? Any capital improvements that you've documented?
I think I bought it for 185. I've lived there a long time, like 20.
Yeah. So what is it worth?
Years.
North of
and it's worth like 650.
Okay. So so basically.
Is she alone, or are you married?
Are you married, or can you get married quick?
So that I can claim both.
Take 500.
Claim 500,000, and then you basically won't have capital gains. So that's the point, right?
I think so. Yeah.
Yeah. So if you don't have, Dawn's right. If you can live with the capital gain, and then you would, if your reason of thinking of carrying paper is just for the capital gain, if it's a primary residence, you have other strategies. But if you're doing it because you just want to, that's different. But thanks, Dawn, for bringing that up.
Okay.
Hi, Dawn. This is Kathy. Can you hear me?
Yeah. Hey, Kathy.
Yes.
I wanted to go back and talk to Denise a little bit about her properties in Jacksonville.
Okay, great.
Yeah, she has an area where there are quite a few investors in that area. And one of the things that I did on some of my properties, which I've now all converted to notes, I don't own any rental property at all anymore. But I started off by looking at the two like she has. She's identified a couple that she would think about getting going ahead and getting selling or whatever. I looked at them and said, what could I do with another investor? Have them give me enough money to pay off the loans or get very close to paying off the loan so that I have very little basis left in that note and then sell it to an investor. So there are, many opportunities for her. She could go back to her property manager and ask what other investors are in the area that might be interested in her properties. And she could do a portfolio. She could do more than one. And that way getting a better down.
Do you mean like them bringing in, 50% down? So it wipes out the, the bank loan.
I'm interested in exploring that a little bit more, like how exactly that works. So let's say I've got a property that would probably sell for, I don't know, let's use round numbers, call it 220 today. That has a note on it of about 72 grand.
Uh-huh.
And I'm willing to part with that and turn that into a seller financing. So the end result being I keep at least preferably a little more cash flow than what I have today.
Yeah, I think you'll probably, if you factor in what you should be over the years, that 35% reserves, you're definitely going to almost double your income probably.
That's what I'd be looking for.
Right.
So how did I go about doing that? I guess that's the key question.
Oh, well,
consider it. How would I go about, right?
Kathy, you started talking. I didn't mean to hijack you there. Do you want to finish a thought or answer that?
Well, I was just saying that's exactly what I did too. I said, how could I go ahead and start kind of laddering out? I didn't do them all at once. I decided because you're going to have some tax consequences you have to look at. So I looked at it and said, how many can I sell in a particular year without it impacting my taxes so much? So the first two I had some debt on them. So I wanted the debt to be cleared. I did that by getting a sizable down from another investor, and I sold two properties to him at once, which then qualifies as a portfolio sale. So that just made it a little bit easier so I could get more down. So I paid off the loans and I carried the note. The other thing I looked at is what are the rents that investor can get. So you have a property value that's inflated now, but the rents may not satisfy that property value, meaning that you might have 220, but more than likely you can't rent it for even 1% of that, which would be about 2,200. So I looked at it. I know that investor has to have some cash flow. So I worked the numbers, and that's how I came up with my deals so that they could be successful, because I didn't want the property back. I wanted the cash flow from the property. And then I had a low basis because now I have no more money left in the property. So I was able to, my yield was very attractive on my equity. So you kind of look at it. It takes a little bit of math to think about it and think what you're trying to do. See if you can get someone interested as an investor. And it's just going back and forth with that deal, saying, can you be successful at this? And I need this. And so I look at it, I always put a price out that's a little bit more attractive for my side. And I have a basis that says, what's my lease that I'll accept for it? And I stick to those numbers. And if it's not that person, I go on. I go find another one. And I've been able to sell all of mine that way.
Kathy, such great comments. And tell her, maybe just go to but how do you find that investor?
It's the first thing I would do, since she's not living in Jacksonville, I would ask her property manager. More than likely, they have other investors that they are managing.
I get contacted by investors in Jacksonville like multiple times a day sometimes. Right?
Well, some of those are wholesalers. They're not the ones that have the money.
A lot of them are wholesalers. A lot of them, their data's out of date. There's, that kind of thing. But even just, for the most part, I just ignore them. Although I save a lot of, I keep a file of kind of the post.
Yeah, I did too. Until I was ready to kind of look at that and say, what does it look like? I wanted somebody that had deep pockets and the reason I wanted somebody that was established is because I really didn't want the property back. Once I made that decision to sell it, I didn't want to have to come back and have to, sell it again. If I But I created two things. I created, make sure their cash flow was well enough that they would be satisfied with it. And I created my margin of what if I got it back, I had enough room to sell it again.
Got it. Okay.
So I looked at both of those things. And in today's market, probably the equity is attractive. It may be that you have to work on the rent side to say what I have to get. Maybe I have to lower my price a little bit to have the investor be satisfied with their return. So to put both hats on, in other words, what I'm saying to you.
Yeah.
So the selling side is attractive, but from the investing side, it might not be.
And when you sold yours, did you sell them with the renter in place?
One I did and one I did not. And so, but the renter had like 6 months left on the lease, and they were fine, and they've actually stayed in the property. That because I happen to know the investor that I sold it to, and the other one he had to go in and do some real minor things and then put it in and tenant in. So,
You know, thank you, Kathy. Excellent. Fantastic. Is your property manager a broker? Do they do listings and sales? Usually they are.
Yes.
So you can ask them and see if they'll hook you up for a flat fee, but likely, you can say, hey, what's the best rate you can do? Because they're probably going to double end it, right? But you can just list with them and just say in the listing, basically, I'm going to need whatever you're going to need on that property. It's good underwriting to take the down payment amount that covers your loan. That's about 30% down, right? So, but to Kathy's point, it's got to make sense for an investor, or maybe a homeowner would do it. I don't know, but if you take 30% down, I think that's great, especially in a mortgage foreclosure state, judicial foreclosure. And just list it saying owner must carry. Or owner will carry with, you're going to want to probably calculate the payoff on your loan plus all your closing costs, so you have zero out of pocket to close the deal.
Right.
And then you'll carry the rest at and you may have, depending on advertising laws, you may have to specify, based on approved credit, but just getting I'll be willing to carry at 5, 6, 7, 5-6%. And then just list it and let them do their job. But if it's your property manager, I would, you're just handing them a commission. So maybe they can do, a pretty good deal for you. Likely they're going to double end it because they'll go to their own investors who are already doing a bunch, like Kathy says, they're seasoned and they're not a surprise landlord.
Right.
Or perchance someone will come in, that wants to live there, and they just got their inheritance and they can afford the, 80 grand down, or whatever. So fantastic. And any other comments for Denise? Any other questions that didn't make sense to anyone that we talked about? And then Denise, you have a note. You end up with a note, and then always remember that note, you can sell off a front end partial if you need to.
Mm-hmm.
Okay. So there's nice liquidity. It's much easier than, it's very easy to sell off a front end partial and especially if you want to take no discount, then cultivate your friends and family who are happy at the face rate of the note, and then you can shake liquidity loose. So another way to go about the business and make arbitrage is to cultivate friends and family money partners that they're never going to do it on their own, but they trust you, and they're, you're carrying a $150,000 loan and they're only in it, 50,000. They're very safe. And you're not only not taking a discount, sometimes you can take a premium.
Right.
It's just depending on how good you are and your access to people with capital that feel confident, working with you on that. That's sort of a hidden way that I just thought of to flush out that idea a little bit more. But thank you so much, Denise, and
thank you.
all the people.
Svetlana, Kathy, others for speaking up. I appreciate it.
Yeah, good. It's there's no reason to get super fancy. It's just a very It's very common. In fact, before in past decades, it was so common that people just carried paper for each other a lot, back in the olden days, the olden days. But then we got dependent on bank financing, and I like it if we don't. Like you guys know, I haven't had a bank loan in over 25 years. I think it's been well over 25 years. Well, I think we're going to wrap it up for today. Is there any last minute questions or comments before we do? I appreciate all of you so much. All right, then just remember to go out there and create financial solutions, one mom and pop to another. I'll catch you next time. You guys take care. Have a great day.
Thank
Thanks.
you, Dawn. Always wonderful. Thank you.
You guys are amazing. Thank you.